Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Investor sentiment across the Asia-Pacific seems a little mixed. Equities are confined and cryptocurrencies do remain volatile. All of this as markets look to this month's rate decisions from both the Fed and the Bank of Japan. Today's outperformer, once again, is the South Korean equity market. Earlier today, we had the Bank of Korea reporting a revised GDP growth number of 1.3%. That's quarter on quarter, making for the fastest pace of growth in nearly 4 years. And that's where we start our conversation with Frederic Neumann. He is the chief Asia economist at HSBC. He's also co-head of global research for Asia. Fred spoke with Bloomberg TV host Paul Allen and Avril Hong.
So when it comes to growth and the inflation dynamic next year, which do you think we should be more worried about in Asia?
Well, if you look at the headline GDP numbers, they were very strong in the last quarter, beating to the upside in most Asian economies. But the foundation is more fragile than it appears, because exports on the AI hardware area, they're doing very well. We're seeing certainly rising equity markets, maybe top-end consumption is doing okay. But broader consumer spending just isn't firing up. And we're seeing some signs of sluggish investment coming through as well. So despite the very encouraging headline growth picture, it doesn't look like these economies are going to generate any inflation. And so if there's any kind of crack in the export picture, then central banks will need to cut interest rates across much of the region, at least emerging Asia. Japan, of course, is an exception. Maybe Australia is an exception as well. But broadly, inflation will likely surprise to the downside over the coming year.
Do Asia central banks have that space to cut? And how important does that mean we need to see that coming from the Fed in the first half of next year?
Well, there's an interesting divergence here because the U.S. is probably sitting on more sticky inflation pressures than much of Asia is. If you look at core inflation across much of the region, think India, for example, think Indonesia, economies really seen very low core inflation. China is, of course, toying with sort of deflationary pressures. And that all that suggests that actually the inflation setup in Asia is different from the U.S. Now, what might happen is that the U.S. Federal Reserve is not going to cut rates at all next year, but Asia will continue to have to cut rates. So we see this divergence here potentially in monetary policy trajectories. And this rarely happens, but it will, of course, have implications for FX markets. And it will just signify how the U.S. is, well, exceptional.
On the topic of China, you mentioned deflation. We also had those very weak PMIs over the weekend as well. But today we've got Finance Chief Lan Fong calling for policies to boost consumption, speed innovation as well. Do you anticipate we might see some stimulus in China in 2026?
We almost certainly will have to see some stimulus because its trajectory in the last few months has been towards weaker and weaker growth. And if you just extrapolate that into 2026, they would have a challenge meeting growth targets around 4.5–5%. Of course, we don't know the growth target yet, but it would certainly mean the economy undershoots its broad trend. And therefore, it's almost baked in that we get some stimulus. The question is, how large are these packages going to be? And probably we're just going to be in a period where we just have incremental marginal stimulus just to provide enough to put a floor on the growth, but nothing that kind of generates a growth impulse, an inflation impulse for China, let alone for the rest of the world.
Well, there's a risk that China perhaps exports deflation, as you say, but some of the other big economies in Asia are also spending big. We're expecting a big fiscal package out of Japan. South Korea's just announced a very chunky budget with a focus on AI and other critical industries as well. Do you see this potentially becoming a trend?
It is a bit of a trend. In fact, not just in Northeast Asia, but even in Southeast Asia, you're seeing a bit of a tilt towards potentially more populist fiscal policy in the sense that it is aimed at consumers, is less aimed at infrastructure, for example. So there's a bit of a fiscal expansion creeping in, even in Southeast Asia, and that is, of course, aimed at reducing the cost of living burden for average consumers. It's designed to revive consumption, which has generally been quite sluggish. Question is, are these packages big enough to obviate the need for central banks to cut rates? Outside of Japan, probably not. Yes, there's fiscal easing, but in terms of magnitude, it's not going to let central banks off the hook not to cut interest rates.
Fred, to your point about the inflation picture maybe surprising to the downside next year, to what extent might that be offset by some of the import inflation we might see, given how currencies, even with the dollar soft, some of them still look pretty vulnerable and weak?
You're right. We have seen very weak currencies in some Asian markets. India comes to mind here. Korea's currency, of course, being somewhat weak as well. Now, that means that there is some degree of import inflation, but the broader picture is because oil prices globally are down, because food price pressures are easing, and because there's just very little local demand to tighten labor markets, we're not going to have a major impact from that currency depreciation. And so central banks who are traditionally worried about FX depreciation might at some point conclude, look, maybe the currency depreciation is just baked in. We have to focus on the price trends. And the price trends are kind of undershooting what we want long term from our inflation target. And that would kind of raise then the pressure to start to ease monetary policy again. Markets are not necessarily pricing this in at the moment, but we feel that the growth risk and inflation risk are such that there's certainly room for most central banks in Asia to continue to cut rates into 2026.
What about the uneven rate of growth within economies that are AI heavy? Is there anything that policymakers can do to perhaps even out the growth a little?
I think you're right, and that's a sort of key phenomenon. Is sort of we're seeing a K-shaped recovery in some of these markets. Think of Taiwan's economy, 8% growth, 8.2% growth last quarter. But if you look at consumer spending, not very strong. And of course, that's because, as you say, most of the growth is driven by AI hardware, exports of chips, etc. But it's not really trickling through to the broader economy. Labor markets are relatively soft. We're seeing consumer spending being sluggish as well. What can governments do? It's partly dial up fiscal stimulus, and we're seeing a tilt in fiscal stimulus towards consumer support. Of course, China has led this, but in Taiwan, for example, we're also seeing that with the handout of vouchers for households, for example, spending vouchers. And we might see more of that across the region just to try to even out a little bit the growth drivers, because a K-shaped recovery ultimately implies very imbalanced growth, and that's not healthy in the long term.
That was Frederic Neumann of HSBC speaking earlier with Bloomberg TV host Paul Allen and Avril Hong here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Stateside, we had a cautious rebound in U.S. equities. A portion of today's risk-taking seemed to be tied to a rebound in cryptocurrencies. We had Bitcoin recovering most of Monday's decline, rising by more than 5% to just under $92,000 in New York trading. Now, analysts were saying the rebound offered a brief respite in a months-long rout, but sentiment, they say, is still fragile. On the equity side, we had the S&P rising for the sixth time in 7 trading days. Markets are still awaiting the last few economic reports before next week's Fed decision. We'll get that PCE data on Friday. This, as you know, is the Fed's preferred measure of inflation. For a closer look at market action, I'm joined by Chris Zaccarelli. He is the Chief Investment Officer at Northlight Asset Management. Chris is on the line from Charlotte, North Carolina. Thank you for making time to chat. Can we begin with the inflation story? I'd like to get your view. What is it?
Yeah, I think those concerns are warranted. Clearly with what we've seen with services inflation and to some extent goods now with tariffs for 2025, inflation has been coming down from the highs, obviously from a couple of years ago, but has really started to kind of stick along at that level, right in the high twos, depending on how you're looking at it, whether it's the PCE or looking at the CPI. But clearly it doesn't seem like inflation is going to get down to the 2.0% target anytime soon. However, maybe just being in the twos is good enough for some of the committee. I think next week, even if they cut rates, which looks increasingly likely based on the interest rate probabilities, I'm sure there's a possibility of dissent and possibly a couple of dissents just for that reason alone. As the committee weighs unemployment versus price stability, clearly the committee has been weighing a little bit more unemployment and keeping the labor market as their highest priority. But clearly there's a lot of Fed governors who are uncomfortable with where the inflation picture is and where it may be going.
So the 2-year yield was down about 2 basis points today. Right now we're around 350. A lot of that is a reflection of the bet for a dovish Fed in the new year. We're also going to have, after the first of the year, the name of President Trump's choice for Fed chair when Jay Powell's term expires in May. Are we going to see a much more dovish Fed, do you think, going forward?
Well, clearly, whoever Trump does pick for the Fed chair will be significantly more dovish than Powell. And Powell has been cutting interest rates, so you can't say he's been in the inflation camp. So, yes, I think we're going to see the Fed have a tone that continues to emphasize emphasize unemployment over inflation. So, at the top of the Fed in terms of the president, it's going to be dovish. But obviously, it's the entire committee, and we'll see how the committee acts next week in terms of whether or not we get a so-called hawkish cut with a 25 basis points reduction in rates and then a number of dissents. And then we'll have to see next year how well the new Fed chair is able to corral the rest of the members, because it is a committee. It's not completely decided by the chair, of course.
One of the things that we do know is that the optimism around lower interest rates is underpinning the equity market. Do you expect that to be the story going forward, particularly as we look into the early part of 26?
It does appear that way. And I think it's really important to distinguish between, whether the Fed is cutting rates or raising rates. So to the extent that it's really a choice between keeping rates constant and cutting rates, of course, all things being equal, the equity markets and, the short-term fixed income markets are going to appreciate lower rates. But as long as equity investors are able to see continued earnings growth, a resilient consumer, even if interest rates stay the same and there's no risk of the Fed raising rates to fight inflation, I think it's still a positive backdrop for equities. So I wouldn't be surprised to see some of this momentum continue into the new year.
So I think it's fair to say that some of the risk taking that we saw in the equity market today seem to be tied to a rebound in crypto. When you look at Bitcoin as one example of the crypto space, what do you learn from its price action, and how does that help guide your choices when you're putting new money to work, let's say, or making adjustments in your equity trading?
So for us, when we look at the price of Bitcoin, let's say, or just the crypto market in general, it is really a risk barometer to us. I know for a long time people were saying it's a digital gold, it's a way to diversify against inflation, and we've seen that in some cases that's been true. But largely for this year, if you look at the price of gold versus the price of Bitcoin, it seems that it's not really a digital gold in a literal sense. It doesn't really mirror the inflation fighting prospects of gold. It really is a risk barometer. So we look at the price of Bitcoin or cryptocurrencies in general, similar to how you look at the VIX. Maybe it's the inverse of that. But the idea is you're really looking at are we in a risk-taking market, or are we in a market where people are getting more fearful? So to some extent, you can really look at crypto as a real-time barometer for risk-taking in general. Generally speaking, we're making a lot of our investment decisions on a strategic basis and doing it in an asset allocation framework. But absolutely, if you're looking at how to put money to work, taking into consideration some technical analysis and other factors within the market, RSI, et cetera, it's one more factor to look at. And it is helpful from a short-term timing point of view to see where markets are from a risk-taking point of view.
So we're about 3 years now into the story around artificial intelligence. It seems as though the sky is the limit right now. Where are you right now in understanding the AI trade and its durability?
So the AI trade is something that, clearly a lot of people have been talking about all year in terms of whether or not we're in a bubble and, how are valuations, are they too stretched? And, clearly in November, we saw a lot of those fears, materialize in terms of people getting a little bit concerned about some of the more speculative aspects. We think the underlying trend is still there. We obviously see, NVIDIA, Microsoft, Amazon, Google, especially lately, the Alphabet's company, continuing to have momentum in the stock market. And we think that momentum in stock prices is underpinned by fundamentals. There's clearly a lot of artificial intelligence spending. And so for that theme to play out, we've moved from chips to applications. Clearly OpenAI and ChatGPT are the poster child for, the first round of AI. But we think as AI spreads throughout the economy, makes its way into other sectors and other industries, that's where you're likely to see the best risk reward opportunity going forward. I do think there's a lot of speculative plays around the edges, and we saw a lot of the air get let out of that bubble in the previous month. But you've seen the Mag 7 slow down, but really not stumble. And if anything, you've seen Alphabet really pick up the charge and go forward. So we do think that Mag 7, that large tech trade, will continue, and we think it's too soon to on the death knell for artificial intelligence at this point.
Okay, but that said, if you are seeing amazing gains in some of the Mag 7 names, would you be inclined to reduce a little bit of risk right now, lock in some of those gains, and maybe redeploy and look at some of the other 493?
Yes, I do think that makes sense. And I think part of it is just good risk management. As that portion of your portfolio grows to a larger and larger weight just through its own stock returns, it does make sense to trim. Again, we've never advocated for overweighting the Mag 7, and likewise, we wouldn't advocate for drastically cutting your exposure to the Mag 7. There's a reason why there's so much interest in those companies. And as I mentioned, unlike the 1990s, where a lot of the speculative stocks didn't have earnings or even revenues in some cases, clearly the Mag 7 has fantastic revenue growth and very good earnings growth as well. So it makes sense to continue to be invested in most of those names, if not all of those names. But we are trimming a little bit at the edges just from a pure risk management point of view.
So you mentioned that valuations may be a little bit stretched. I hope I'm not putting words into your mouth, but I'm wondering whether or not this is also a time, if you're looking to diversify, to examine what's happening in markets offshore, maybe in Asia or Europe or Latin America.
Yeah, absolutely. Again, to go back to the valuation point, clearly it's much more expensive than it has been over the 20-year average. If you're looking at 22.9 times earnings, versus, a more typical 16 to 17 over a longer time frame, or even high teens, low 20s over, let's say, the more recent 5-6 years. It's still a little bit high. Nothing like what we saw in the late 90s in terms of the overall market. But generally speaking, you are seeing pretty rich valuations, fair to maybe slightly overvalued for some of these really good quality companies, and potentially overvalued for some of those other companies which are more speculative. So yes, we do think it makes sense to diversify. We've always been a believer in spreading out beyond just the S&P 500, both in the U.S. within mid caps and small caps. And we do think internationally there's still opportunity. Clearly, developed markets have done very well this year, and even emerging markets have also done well. And we do think that will continue. And we think it makes sense not only to have that diversification in place all year long, but as you head into 2026, I don't think you've missed it in terms of continuing to diversify a little bit away from the U.S. And just broadening out that portfolio more globally.
Chris, before I let you go, as you look to those markets offshore, are there themes that you could identify? Is it still kind of a tech play right now when we're talking about AI, particularly markets in Asia?
So yes, looking over in Asia, I would say it's a little bit more tech focused. Looking in Europe, I think there's still opportunities within industrials, within financials. Clearly that change from a lot of the European governments to focus a little bit more on funding their own defense and starting to invest in defense. We think defense companies have done pretty well this year. They can continue to do well into next year. And likewise, we think the entire European complex, it's had a 1-year recovery, 2025 versus lagging the United States for many, many years. We think that can continue into 2026, where you'll continue to see European markets and Asian markets keep pace or potentially outpace the S&P 500 next year.
Okay, Chris, we'll leave it there. Thank you so much. Chris Zaccarelli is the Chief Investment Officer at Northlight Asset Management, joining from Charlotte, North Carolina, here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.